Look, we've become net importers of gold since November. And, there's no coincidence that's when he won the election. The amount of interest that we've seen on all levels, precious metals, since November, and the crumbs that have been left along the way from people such as Donald Trump himself, Treasury Secretary Bessent, Judy Shelton. I mean, on Easter Sunday, Trump says by tweet, he who has the gold makes the rules, the golden art of negotiating. That comes after massive imports since November. In 35 years, I've never seen that, ever, never. Maybe 1 month here, 1 month there, but now month over month, we're seeing massive inflows into the COMEX. We're seeing the draining of the exchanges and the LBMA and the COMEX. And then you're seeing all sorts of rhetoric that would lead one to believe that things are different this time. But the interesting thing about it, when you take a step back and you look at the macro picture, Steve, what you see is something that I think really screams to the contrarian in me. And that is that since the beginning of the year, we've seen massive selling in equity by the insiders, the institutionals, the insiders. We just saw Jeff Bezos sell another $5.7 billion in Amazon stock. You got Warren Buffett sitting on $500 billion in cash and treasuries. You have Jamie Dimon selling. You have Zuckerberg selling. You have all of the insider selling. Since June, the institutionals have been selling on average $2 billion per week. You had the top 3 largest shareholders and board members of NVIDIA dumping hundreds of millions worth of stock. Now, this is at a time when the insiders are all leaving and the retail public, the mom and pop, have a larger exposure to the equity market than ever before, ever, including higher than the dot-com bubble at about 53, 54% of all stock ownership is owned by the retail public. At the same time, you're seeing the public really not have much exposure at all to metals on this level. And in fact, Rick Rule often says 0.5%. That's probably being generous. While you're seeing the exchanges being bled dry. Now, to take possession of what amounts to, or to have delivered at what amounts to over 100 billion in gold and silver, 100 billion since the beginning of the year that we know of. A lot of central banks are now admitting to buying privately from local and artisanal miners, not doing it through the normal channels that would get cataloged, like through the COMEX or through import-export numbers coming out of London or Switzerland, but that we know of 100 billion. So the insiders are going deep, deep, deep into physical commodities and actually taking possession, pulling them off of the exchanges while the public is going the opposite direction. So you have massive influx in metals by the insiders and leaving the equities by the insiders. It's the polar opposite by the retail public. What could possibly go wrong? Yeah, I think you're looking at a setup for a very big second half of the year, and I would expect the fall to, show that. The insiders don't take possession in May of $8.5 billion in gold off of COMEX. This is 1 month that we know of, without it being something that they've given a lot of thought to and probably know the playbook, because at that level, those people just don't have the most money. But to take possession of that kind of, or even just to deliver that kind of volume into COMEX is incredibly sophisticated. And it's not something easy to do. You'd be far easier for someone to give me $500 million and have me go out and scour the world and get them gold bars and stuff than it would be to take possession of metal. Now you're talking 100 billion off COMEX. So something deep is going on, and I would expect that to translate at some point into the retail side, as they're always late. The public is always late after the insider's position. I think that's where we're going. So I'd say buckle up for the second half of the year. Whether or not they're positioning in precious metals, the same people that are selling equities, what I would say is that the big money is leaving the risk of the equity market, which is trading at all-time highs, and really disconnected from the economy. At the same time, the public is going all in on equities when the insiders are leaving. And then at the same time, big sophisticated money is delivering more gold and silver into COMEX than we've ever seen in the history of the exchange, ever. Month over month over month over month over month, we become net import. These are very sophisticated, institutional, in-the-know buyers, and the public has virtually no exposure at all. So whether they're the same people doing it, probably are, or not, I guess I would just simply say the sophisticated traders are leaving equities and buying commodities. It's the polar opposite for the public.
When you step back and look at what's been happening since last November, it's almost like watching a movie where the plot twist is obvious to the audience, but the main character is oblivious until it's too late. The United States, believe it or not, has quietly become a net importer of gold. That's not some conspiracy blog, that's a matter of official numbers. And when did that shift happen? Right after Donald Trump won the election. Call it coincidence if you want. But in my world, when elephants start dancing, you pay attention to the vibrations. Now here's the thing. In 35 years, I've never seen this. Never. Maybe you'd get a fluke one-off month where imports outstripped exports, but not month after month, sustained, with massive inflows. We're talking about gold being vacuumed into the US on a scale I haven't witnessed in my entire career. And right alongside that, you've got Trump tweeting on Easter Sunday, "He who has the gold makes the rules. The golden art of negotiating." You can laugh about Trump's Twitter habits, but that's not the kind of throwaway line you type between cheeseburgers. That's a breadcrumb. Then you've got Judy Shelton, longtime gold advocate, almost made it onto the Fed board. Back in the conversation, you've got Treasury Secretary Steven Mnuchin making subtle references about America's great balance sheet while standing in front of Fort Knox. All of this, taken together, starts to paint a picture. And if you've been around this space long enough, you start to feel it in your bones. Something big is shifting under the surface. Now here's where it gets really contrarian. Since the beginning of the year, insiders, the people who actually run the companies and know the real numbers, have been selling equities hand over fist. Bezos sells another $5.7 billion worth of Amazon. Zuckerberg sells. Jamie Dimon trims. Buffett is sitting on a $500 billion in cash and treasuries, which in Buffett speak is basically a giant neon sign flashing, "I don't like the risk-reward here." And then you've got NVIDIA board members dumping hundreds of millions at the very peak of AI mania. That's not conspiracy theory, that's SEC filings. Meanwhile, who's buying all these shares at record highs? Mom and pop America. Retail ownership of equities has surged past 53%, higher than the dot-com bubble peak. The public is more exposed to the stock market now than at any time in modern history, and they're leveraged to the hilt. Record margin debt, record options speculation, it's all in poker, and we know how that usually ends. Now contrast that with what's happening in metals. Insiders, big, sophisticated money, aren't just nibbling, they're feasting. They've pulled over $100 billion in gold and silver off COMEX since the start of the year. That's not interest, that's an outright raid. And remember, the actual number is likely higher because central banks are now openly admitting they're buying directly from artisanal miners and local sources, bypassing the exchanges and avoiding official reporting channels. Let me just pause and say this. For someone to take delivery of billions of dollars worth of gold off COMEX, it's not like buying a stock on Robinhood. You don't just click a button and a pallet of 400-ounce bars shows up at your door with prime shipping. This takes enormous sophistication, infrastructure, and planning. It's a whole operation. Contracts, transport, vaulting, security, insurance. It's sovereign level. These aren't hedge fund bros in hoodies doing this. This is state-level, institution-level accumulation. So what do we have? Insiders dumping equities while retail plows in at record levels. Insiders and sovereigns buying metals hand over fist while retail has almost no exposure. Rick Rule likes to say that less than half of 1% of global assets are in gold. Honestly, that might be generous. Retail owns practically nothing in this space. The disconnect is staggering. And here's the kicker. The public always moves last. Always. They chase trends after they've run. They buy stocks when they're euphoric and dump them in despair. They ignore gold and silver until the headlines scream, and then they pile in right before the insiders exit. It's the same story again and again, which is why when I see this setup, I don't say it lightly. Buckle up for the second half of the year. Something's coming.
No question, I believe they're going to destroy the dollar. I think that's what they're intending to do to save the system. How do they do that? I think ultimately you see the stablecoin bill that is being used to flood the front end of the bond market with short-term debt issuance, which when Janet Yellen did it, we saw how beneficial that was for metals and for equities and for cryptocurrencies. And as Luke Groman, I think aptly puts it, they want to anesthetize the back end of the market. And here is the thing. when you look at where we're at the back end of the market, the 10-year treasury, you're going to see rates continue to move higher because just bottling up a few facts, we have $28 trillion due in 3 years in maturing treasury. That's fact. 28 trillion by 2028. We take in 5 trillion a year in tax revenue. That's 15 trillion. You're halfway there. That doesn't take into account the 3 trillion plus per year in deficit spending. They just came out with their projection for the next quarter. They want to print $1 trillion over 3 months. So the point of it is that 3 trillion per year deficit spending minimum over the next 3 years is another 9 trillion, 28 and 9, 37. We take in 15 trillion in tax revenue. We're, hardly 25% of the way there, basically. So how do you do that? How do you finance that at a time when the rest of the world is shedding treasuries like China and Japan and Saudi Arabia? And now we're supposed to believe that the United Kingdom, one of the most indebted nations in the world, is buying the debt of the most indebted nation of the world. They're number 2, and the Cayman Islands and Ireland. The whole thing is a shell game. So what I believe that they are going to do is, first and foremost, let's look at, we've become a net importer of gold, and month over month we're seeing massive inflows of gold every single month. I asked Judy Shelton, who was Trump's nominee to run the Fed in 2016, do you think that they're going to issue gold-backed treasuries? That was what her book was all about. On my interview with her, she said there is no question, in no uncertain terms did he say to me, July 4th, 2026, he will do that. It's a big day for him. It's the 250th year anniversary of the country, and he will issue gold-backed treasuries on the back end of the market that day. Now think about this. If you are reshoring all the gold, you let the price rise. Even Luke Gromen thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called valuation. You can't make it up. That's the name of it. If they did revalue, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, it would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation, but now that would give the Treasury general account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it. Prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in '33, gives the money to the Treasury. Now the Fed doesn't own that gold, they own the dollar value of the gold. The gold belongs to the Treasury and to the American people. Now they start paying down their debt. They don't have to issue any long-term treasury. They flood the market with stablecoin issuance on all the cryptos that fund the short-term treasury debt to keep the game going. And with low interest rates, if you back the treasury, the long end, like the 50-year to start with, as Judy says, and then 30 and 20 and 10 later, shorter durations over time.
So let's carry this forward, because the picture isn't just about what's happening in the vaults of the COMEX or the insider trading desks on Wall Street. It's about what's happening at the level of global monetary architecture, and this is where things get both fascinating and, frankly, a little terrifying. We've entered an era where the US dollar's dominance is being openly challenged in a way I haven't seen in my career. Not quietly, not on the margins, but outright. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding circle of friends, aren't just talking about alternatives anymore. They're actively building settlement systems, launching commodity exchanges, signing bilateral trade deals in local currencies, and most importantly, hoarding gold like it's going out of style. And you've got to ask yourself, why are they doing this now? Why is Russia creating a domestic gold exchange in St. Petersburg to sidestep the LBMA? Why is China taking in record tonnage every month, sometimes openly, sometimes through sovereign wealth funds, sometimes by quietly buying ore directly from miners in Africa and South America? Why has India been importing silver at volumes that make the COMEX look like a corner jewelry store? It's because the rest of the world has figured out that the dollar is not a neutral reserve currency. It's a weapon. And once you weaponize something, people start looking for ways to defend themselves. Think back to 2022 when Russia's reserves were frozen. That was the starting gun. Every finance minister in the world saw it. Your reserves are safe until Washington decides they're not. So if you're running policy for Saudi Arabia, or Indonesia, or Turkey, or even Japan, You've got to ask, do we really want all our eggs in that basket? And here's where it ties back to Trump's little Easter tweet: "He who has the gold makes the rules." For decades, we operated under a system where he who has the dollar makes the rules. But if the dollar's credibility is waning, the logical replacement isn't the yuan or the ruble, it's gold. Because gold is neutral. Gold doesn't carry an army. Gold doesn't sanction. Gold just sits there, immutable, immune to politics. Now, I've been saying this for years. When the insiders start talking about revaluing gold, you better pay attention. And what do we see? Not fringe bloggers, not conspiracy theorists, but Bank of America analysts like Michael Hartnett saying outright that central banks will be forced to revalue their gold reserves because of crushing debt burdens. You've got Francisco Blanch, also at BOFA, writing that gold is no longer a barbarous relic, but a key strategic asset. And then, most jaw-dropping of all, the Federal Reserve itself publishing papers discussing how gold revaluation could help alleviate debt stress. Folks, when the Fed is even entertaining this conversation, the Overton window has shifted. And think about what that means in practice. If gold is revalued from, say, $2,500 an ounce to $10,000 an ounce, suddenly the Treasury's gold holdings explode in value on the balance sheet. That's trillions of dollars of capacity to soft default without ever announcing a default. That's a debt jubilee by stealth. Politicians don't have to cut entitlements or face angry voters. They just wave a magic wand, revalue gold, and suddenly the balance sheet looks healthier. It's politically irresistible. Now, some of my friends like Alasdair Macleod will argue that it won't happen, that the system will collapse before the authorities willingly admit defeat, and I respect that view deeply. But I disagree. I think when push comes to shove, and when the bond market finally revolts, policymakers will reach for the only lever left: gold. They won't call it a reset. They won't call it a default. They'll wrap it in some patriotic branding about restoring America's balance sheet or modernizing our reserves. But the outcome will be the same: a massive upward repricing of gold, and by extension, silver. And speaking of silver, let's not forget the little brother in all of this. Silver is the most undervalued asset on the planet, period. It's both a monetary metal and an industrial metal, which means it gets demand from two directions: solar panels, EVs, 5G, AI server farms, you name the future technology, and silver is in it. And yet we're trading at a gold to silver ratio north of 80 at times, when historically 16 was considered the equilibrium. That's not just undervaluation, that's an arbitrage opportunity written in flashing neon. Look at the flows. India imported 8,000 tons of silver in 2022. That's more than COMEX's registered inventory. Mexico is tightening export controls. Industrial demand is rising every year. And still, the paper markets suppress the price with 100-to-1 leverage of contracts to physical. But here's the rub. When sophisticated players actually stand for delivery, as we've seen in recent months, the game changes. Less than 1% of contracts historically went to delivery. Now we're seeing numbers in the 10%, 20%, even 100% range in certain months. That is a structural shift. And let me remind you, in just the first 3 days of the August contract, 20,126 contracts stood for gold delivery. That's $7 billion in metal. In silver, 1,064 contracts stood, over 5 million ounces. And here's the kicker. Every single contract has been settling in physical. That's unheard of. Normally, most contracts are rolled or cash settled. But now, people want the metal. And not only do they want it, they're taking it out of the system. Loadouts are accelerating. Vault withdrawals are accelerating. The metal is leaving COMEX and not coming back. So ask yourself, who is doing this? Who has the sophistication and the capital to orchestrate multi-billion-dollar deliveries month after month? It's not Reddit traders. It's not retail stackers. This is sovereigns, institutions, deep-pocketed insiders. They know something. They're preparing for something. And when you line up the breadcrumbs, the Fed papers, the Trump tweets, the Shelton interviews, the COMEX drain, it points in one direction. Gold and silver are being remonetized under our noses. Now let's lighten it for a moment. I saw a tweet the other day that cracked me up. Picture of Jerome Powell with the caption, "When you realize you can't print gold." Underneath was the classic meme of the sweating guy with two buttons. One says raise rates, the other says print money. Powell's hand is shaking. Funny, yes, but also deadly serious, because the Fed is trapped. They can't raise rates without blowing up the Treasury's debt service. They can't cut rates without stoking inflation. They're cornered. And when the firefighter runs out of water, sometimes the only option left is to torch the forest and call it controlled burning. That's where gold comes in. It's the release valve. It's the reset button. And silver, by extension, gets dragged along, often with more torque. Now tie this back to politics. Trump has been unusually explicit about gold. He who has the gold makes the rules. That's not an accident. Remember, Trump comes from real estate. He understands hard assets. He understands leverage. And he's not above bending the system to his advantage. If he sees an opportunity to anchor a new monetary framework in gold, even partially, I wouldn't be surprised if he takes it. Judy Shelton in his orbit makes that even more plausible. So what does this mean for you, the viewer, sitting at home, maybe holding a few silver eagles in a safe, or wondering if you should dip a toe into gold? It means the window is closing. Right now, you can still buy metal at what will look, in hindsight, like laughable prices. Right now, you can still take delivery. Right now, the premiums, while high, are not impossible. But when the public finally wakes up, when CNBC runs a Chiron saying gold soars to $5,000 and your neighbor starts bragging about buying silver rounds, that window will slam shut. Premiums will explode. Availability will vanish. And you'll be left wishing you acted sooner. The insiders aren't waiting. They're moving now. They're selling stocks, selling paper, raising cash, and rotating into real assets. They're draining the exchanges. They're positioning for a world where gold and silver are once again recognized not as commodities, but as money. And here's the irony. Retail investors, the ones plowing into tech stocks at record valuations, could be setting themselves up for the biggest wealth transfer in history. They'll be left holding the bag when equities mean revert, while the quiet accumulators of gold and silver will preserve and possibly multiply their purchasing power.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.